I hope you guys are doing okay. So welcome back to another video lecture. So last time we stopped here, right? So in the previous lectures we talked about how to identify business gross income, and we also discussed how to identify deductible expenses for business, right? So today we're going to move on to the next objective of the chapters, which is accounting methods. So basically we're going to talk about how business owners, they can choose different methods to apply to treat their taxable income and to treat their expenses for the business, right? Right. So first, let's talk about accounting periods. So as we already talked about this earlier in the class, right? So we know that for individual taxpayers, usually the tax year ends on the last day of the calendar year, right, which is December 31st, right? But that's not the only accounting period that are permissible for taxpayers, right? So for different types of taxpayers, there are different types of accounting periods that the taxpayer can choose from, so it depends on the characteristics. It depends on the type of taxpayers, whether or not it is individual taxpayers or whether or not it is flow-through entities, or whether or not it is a C corporation, that the taxpayers can choose different type of accounting periods, based on the characteristics, based on the types of the entities, right? So so we know about the calendar year end, which basically means the tax year ends on December 31st, right? However, there are two other accounting periods that are available out there, that the taxpayer can choose from, depending on, and whether or not the taxpayer can choose depending on the types of the taxpayers, right? The types of the business as well, right? So the first one is the last day of the month, So if you guys have noticed, there's some corporation out there where their tax year is not end on December 31st. Right? I mean, majority of the companies out there still choose their tax year to end on December 31st. But there are some companies they choose to end their calendar year, to end their tax year on, say, June 30th or July 31st or even May 31st, So it's all depend on the choice of the companies, right? And then so that's one, right? And then the other type of accounting periods is called 52-53 week year end, So even though the name is kind of weird, but it's pretty simple. Basically, the business owners can choose the same day of the specific month in the year to end their tax year. So for example, taxpayers choose the last Friday of July every year to be the end of the tax year for the business, right? So that also works as well. So basically there are three types of accounting periods that are available out there. Calendar year end on December 31st, last day of the month, meaning the last date of a particular month that the business owners choose to end the tax year on, and then the last one is 53 week year end, which means the business owner choose a specific date, the same date on the specific month to end the tax year, right? All right. So let me close this up. So as I mentioned, right, so different type of business may be qualified for different accounting period, right? So first of all, for proprietorships, for proprietorship and for flow-through entities, right? Because these types of businesses, they don't have to file their own tax return and whatever income, whatever expenses from the business is going to flow through the taxpayers, the business owners' tax returns, right? So for these types of businesses, the accounting period it has to be the same as the business owner's tax return, because basically they don't have their own tax return, right? So whatever income, whatever expenses from these businesses is all going to flow through the taxpayers, the business owner's tax return, right? So meaning they are not really an independent entity in tax-wise, right? So everything related to tax purpose, it has to go back to the business owners, right? So that's why the accounting period, it has to follow the accounting period of the business owners, right? So basically for this type of businesses, usually the accounting period is going to end on December 31st, right? However, for C corporations, so this is going to be a different case, right? So C corporations, they are standalone entities, and business owners going to have to file a separate tax return for this corporation, right? Because they are on their own, right? So the business owner have to file a tax return for themselves as an individual, and then they also have to file a tax return for the corporation, because it is a standalone entities, right? So for C corporation, because they are standalone entities, they can choose among the three accounting periods, so that's why we can see for corporation out there, some of them have different, some of them don't have calendar year end, some of them don't have year end on December 31st, because they can choose, right? They can choose to end their tax year on a different date, right? So so in general, C corporation can choose one of the three methods, right? And usually, whatever the method that they choose, whatever the tax year end, the year end that they choose on the first year, on the first tax return, they usually they have to make it consistent to the futures, So for example, if the business owners decide that the tax year end, the year end of the C corporation to be July 31st, right? So for the first year, so starting from the second year, the third year, so on and so forth, the tax year end should be consistent, meaning the business owner should keep the tax period to end on July 31st, right? Unless they decide to change, though, that's another story. And in that case, the taxpayers, they have to do a lot of paperwork to register with the IRS, But in general, the C corporation should keep the tax year, the year end, consistent. All right. So So now let's talk about accounting methods. So actually, in accounting, and you may already know about this. You should know about this because you already took principal and intermediate accounting. So usually there are two main accounting methods. There's their cash method and their their accrue method, right? But so basically, in tax, we also have that two main methods. But let's talk about the objectives of financial accounting and of tax accounting. So as you already know, already learned from your principal and your intermediate accounting class, for financial accounting objective, which basically require for financial accounting purpose, corporation or corporation and business owner need to follow GAAP, right? To recognize the income and to recognize the expenses, right? So usually GAAP, the principle usually require businesses to recognize the loss and expenses very early, very quickly, right? And usually they don't really focus their attention on recognizing income fastly, right? And the reason behind that is that the gap mainly focus on protecting the users of the accounting information, right? Which are the investors, the creditors, the regulators, who read the accounting, read the financial reports, and to collect the financial information of the companies, right? So because business owners or managers of the corporation, right, usually they intuitively they would want to maximize their performance, right? Or at least they want to make the performance look good. So that means they would want to recognize the income quickly, right? Because they want to show that, okay, like this year I did pretty well, I make a lot of income, and they would want to postpone the losses or the expenses to overstate their income, So basically, they want to make the performance to be upwardly biased, right? So because of that gap, right, the principle wanted to protect the users, right? They want to protect the users of the financial information from that bias of the managers of the companies, right? So that's why they want the business owners, the company to recognize losses and expenses very fast, right? Way faster than they can recognize income, right? So that is the objective of financial accounting, right? And they call that conservative, because they want investors to know about the losses, about the expenses before they can know about the income, But for tax purpose, right, it's the opposite, right? Because for the tax purpose, the IRS, the government, want to collect as much taxes as possible, right? So, and in order for them to collect more taxes, right, they have to allow the businesses to recognize the income as fast, right? Because the higher the income recognized, the higher the tax is going to be paid on that income, right? So, and then they would want to postpone the deduction, right? Because the more deductions, the lower the income and the less tax that can be collected from business, right? And then on the other hand, as a business owners, as managers of a business, you don't want to pay that much tax, right? So it is the incentive of the business managers to accelerate, right, deductions and postpone recognition of income, right? So Congress and IRS and the government, they don't want that, right? They don't want people to avoid paying tax, right? They want them to pay tax, so that's why they want to accelerate the recognition of income and defer the recognition of the deduction, right? So the objective for tax accounting is opposite of the objective for financial accounting, right? So for tax accounting, the government, Congress, they want to maximize, they want to accelerate the recognition of income and defer the recognition of deduction, right? Meaning defer the recognition of losses or expenses, right? But for financial accounting, it's the opposite, right? GAAP wants companies, businesses to recognize losses and expenses early, right, fastly, but they want to defer the recognition of income, right? So we have to always keep in mind the difference between the objective of financial accounting and tax accounting. So yeah, so this is the big difference, right? So that's why businesses, right, they maintain two set of books. They maintain financial accounting books, salary book, and they maintain a tax books, because the treatment, the accounting methods applied for financial accounting and applied for tax accounting is going to be different, right? Because the differences in the objective right here, right? So we have to keep in mind there's a difference between financial accounting and tax accounting. All right. So as I mentioned, right, there are two main accounting methods that permits the permissible, in tax, similar to financial. Right? There are cash method and there are accrue method. Right? And sometimes there are some scenario where, for tax purposes, where cash basis taxpayers have to use accrue method on certain items. So in that case, we call it a hybrid method, right? But usually, overall, there are two main methods, right? The cash method and the accrue methods, right? All right. So for small businesses, and I believe the benchmark is 26 million. So for businesses with a revenue of less than or equal to $26 million, they can choose to use either cash method or accrued methods. But for larger corporations, for larger businesses, they have to use accrued methods, right? So and then the accounting method usually is adopted from the first tax year, right? So similar to the accounting period, the accounting method should be also need to be picked from the first tax return, and then it should remain consistent later on, right? Consistent going forward, right? But it doesn't mean that the business owners need to stay with the accounting method forever, right? They can change, but the change in accounting method requires some paperwork, some stuff, that the business owner need to do, But yeah, usually, if nothing happened, nothing serious happened, the accounting method should stay consistent, right? And if there's some changes in the accounting method, the taxpayers, the business owners have to fill out some paperwork to register, to inform the IRS, right? But but otherwise, the method should stay consistent and should be adopted from the first tax return, right? All right. So let's talk about the cash method, right? So as we know, the cash method is pretty basic, pretty easy to do, and it's fit for individual taxpayers and for small businesses, right? Because it's pretty simple, it's pretty easy, right? And it's not costly to maintain the book, right? And also it's pretty flexible as well, so everyone can apply the cash method. It's not that hard, it's not that costly, right? But the disadvantages of the cash method is that obviously, right, the matching between income and expenses cannot be that good, right? Because under the cash method we recognize income whenever we receive the payment, right? Or constructively receive the payment, right? Meaning maybe we don't receive the payment yet, but someone already initiated the payment, right? So yeah, and we recognize expenses when we pay the expenses, right? So there's going to be a time gap between the recognition of income and the recognition of related expenses, right? So that's going to be the big or the main disadvantage of the cash method, right? But again, for small businesses and for individual taxpayers who revenues or income is not that great, so it should not be a big problem, But and I want to change this. This should be 26 million. Right? But for larger corporations, they should follow the accrue method, right? Because it's important for those corporations to make a good match between income and expenses, right? And for larger corporation, they have the resources to maintain the book in the accrue way, right? Even though it is expensive, but because they are big, they have the resources to maintain such complex set of books, right? All right. So, and as I said, right, accrue method usually it is much more complex, right? So we recognize usually, as we really know, we recognize income when the income is constructively earned or received, right? Whatever comes first. And there are a test called O-event test where we can use to kind of judge when we can recognize the income, you know. So basically, the O-event test is saying that there are 3 dates that we should follow here. You know, so we should recognize the income on the date of either the date of the date that the service or the sale is completed, or the date that the payment is due, or the date that the payment is received, right? So and remember that this test is only applied to tax for the tax purpose, right? In accounting, in financial accounting, like as you may have learned, there's no such thing called O-event test, right? But so this test alone is applicable for tax purpose only, right? And we were talking about tax purpose, right? So for accrued income, usually taxpayers, usually business owners have to follow this test, right? To recognize the income, right? And as I have mentioned, right? As we have discussed about the objectives between the differences in the objective between financial accounting and tax accounting, right? So look at this, right? So usually in financial accounting, income is not recognized when it is actually earned, right? Meaning when the service is already performed or when the sale is already completed, right? But in here, under the tax, for the tax purposes, the date when income is recognized is already extended to the date when the payment is due or when the payment is received, right? So let's say if the client prepaid for the services that they want the company to do in the future, right? In this case, the business have to recognize the income when the payment is received, even though the promised services that are due to be done is in the future, right? So under the financial accounting purpose, right, the taxpayers, the business owners of this business may have to wait until they complete the service, right? Even though they already received the prepayment from the clients, right? But for the tax purpose, the business owners may have to recognize the income right away, right? Because they already received the payment, and the O-event test tell them that they should recognize the income for the tax purpose on the earliest date of this date, right? Whether the date is the completion of the service, or the date is the payment when the payment is due, or the date when the payment is received, right? So if the date when the payment is received is the earliest date, then they have to recognize the income on that date, right? Even though the service is not even being provided, right? And in this case, the client is prepaid for whatever service that they want in the future, right? So just want to point that out, right? So so as we have just discussed, for advance payments for services or for goods, right? Usually under the O-event test, right? For the cases of advance payments under the O-event test, the business owners have to recognize the business income on the date that they receive the payment, right? So when the clients or the customers, they send the business, they make advance payments to the businesses. Right? Under the financial accounting purpose, the business owners may not need to recognize income yet, right? And it's going to become a unearned income kind of account, right? But under the tax purposes, right, for advance payments, under the following the O event test, the business owners have to recognize the payment when it is received. Right? However, there's some exception, right? And the exception here is that for businesses for income other than interest income and unearned interest income and unearned rental income, taxpayers or business owners are allowed to defer the recognition of income up to 1 year, right? So they can defer for 1 year, even though they receive the payment, even though the O event test say that you have to recognize the income on the date of the payment, on the date of the date when the payment is received, right? The exception case allow the business owners to defer the recognition of the income, but only for 1 year, right? And remember that these exceptions does not apply to rental and interest income, right? So let's look at this example. Maybe it's going to be clearer for you guys to understand this concept. Right. So look at this. So Ben provides dancing lessons, and on September 30th, remember this, right? September 30th of this year, he received a $2,400 full payment for a 2-year service contract. And the question asks, what amount should he recognize if he used the cash method, and what amount he should recognize if he used the accrue method? All right. So obviously, under the cash method, this guy, right, Ben, has to recognize income for the full amount of $2,400, right, because that's the amount that he received, right? So for the cash method, he can just recognize that full amount right away, right, $2,400, right? But under the accrue method, it's a different story, right? So under the accrue method and under the O event test guideline, right, Ben may also need to recognize the $2,400, right? But since he has option to choose, he has option to defer the income by 1 year, right? So if he decides to do so, he can only need to recognize the portion of income for this year, which is so September 30th, the day that he received the payment. So basically, there's 3 months left until the end of the year, right? So in that case, he only needs to recognize $300, right? Because $2,400 for 2 years, so for 3 months, it's going to be $300. So he only needs to recognize $300 for this year, and then for the rest, right, for the $2,100, he had to recognize in the following tax year, right? Even though the contract is for 2 years, right? But for the tax purpose, he's only allowed to defer the recognition of income for 1 year, right? So that's why for the rest, for the $2,100, he had to recognize next year, even though the contract spanned for 2 years, right? So here's the answer, right? So as I said, as we have discussed, under the cash method, he can recognize the income in full amount, right? $2,400 for the current tax year. Right? But under the accrue method, for the current year, he can recognize $300, right? And then the rest of the amount, which is $2,100, he can defer to next year, right? So let's talk about the difference between financial accounting, financial reporting purpose, and tax purpose here, right? So under the accrue method, right, Ben would not recognize the $2,100 in next year, right? Because for financial accounting purpose, right? Because under the financial reporting purpose, Ben has to recognize income as he earned the income rate. So, and in this case, the contract span for 2 years. So, meaning that this year he gonna recognize $300. In the second year, he gonna recognize for $1,200, right? Because it's $100 for every month, right? And then on the third year, on the third year, he gonna recognize income for the rest of it, right? So because the contract span for 2 years, right? But under the tax purpose, even though in the first year he can recognize for $300 because that's what he's earned, he had to recognize the rest of the $2,400 in the second year because he can only defer for 1 year. Right? So you can see the difference between financial reporting purpose and tax purpose. Right? So for tax purpose, the IRS, Congress, the government, they want to accelerate the recognition of income. Right? So that's why Ben had to recognize, had to finish recognizing the income by the second year. Right? But he can only defer recognizing the income for 1 year. But for financial reporting purpose, he may recognize income for the span of the contract period, right? So I just want to point out the differences between financial reporting purpose and tax purposes. Right? They are very different, right? All right, so let's talk about inventories. So inventories, as you may remember from financial accounting classes, right? So for inventory, usually we apply the accrued method to account for inventories. So same here, same in tax, same for the tax purpose, right? So we use accrued method to apply for the input and the output of inventory, right? Even for cash method taxpayers, right? For the tax purpose, they also have to, for some items of inventory, they also have to use the accrued method to account for the input and output of the inventories, right? So that's why sometimes they call there's such things as a hybrid method, right? Because for some items of inventories, even cash method taxpayers have to use accrued methods, right? So right, but and for taxpayers who for individual taxpayers or for small businesses, they can choose to treat the purchases of inventory of goods as expenses. So usually for inventory, right, and once we buy inventory, it's going to come with part of assets, right? Basically, we have to kind of capitalize the inventory, right? So the inventory can become a part asset, and then we cannot expense the inventory until we cannot deduct the inventory until we make the sale, right? Then we can recognize cost of goods sold, or right. So that inventory. But for taxpayers for smaller businesses with revenue of less than 26 million, right, equal or less than $26 million, they can choose to treat the input, the purchases of inventory as an expense, right? And they can just expense right away, right? Which I guess any business would like that, but for smaller businesses, they are able to do that because it doesn't really impact the tax revenue for the government. But for bigger businesses, the government, Congress, and the IRS, they don't allow businesses to do such thing. Right? So for those businesses, they have to follow the accrued method. They have to treat inventories as the purchase of inventories as a part of assets. Have to capitalize basically the inventories, make the income, make that to become part of assets, and then they have to wait until the sale or the performance services is completed to be able to deduct the expenses, the cost, right? But even for the cases where the businesses use the inventory, the accrued method to account for their inventories, there's still a difference. There's still some differences between tax purposes and financial reporting purposes, right? So for tax purposes, the way to account for inventories is a little bit different, and that's why they kind of invented a comprehensive kind of principle, a coherent principle to guide businesses to treat the inventory. And this principle, is this UNICAP principle, and UNICAP stands for Unified Capitalization Principle. So this UNICAP so this UNICAP principle or UNICAP rules can provide large businesses, a guideline to follow to capitalize their inventory for the tax purpose, and help them to account for the tax purposes of inventory better, because there's differences between the financial reporting purpose and the tax purpose. So this UNICAP it provides a set of rules for large businesses to follow, and to make it easier for them to follow, right? So what's the difference between GAAP and UNICAP? Right? So GAAP is for financial reporting purposes. Right? So for GAAP, usually we only consider consider all the direct costs and some item of the indirect cost to be considered as inventories. Right? So basically, we only capitalize certain items, right? So those items include direct costs and only a few items of indirect costs, right? But under UNICAP, the range of items that are required to be capitalized is going to be broader than GAAP. So under UNICAP, some indirect costs such as costs are related to the administration expenditures, may also need to be capitalized, right? Because the government and Congress they want to delay the expense of the deduction of the expensing, right? So by increasing the amount of capitalizations of inventory, they can, in a way, delay the deduction of the cost rate. Instead of following GAAP, under GAAP, the range of the item that can be capitalized is much smaller. So the amount of, and then because of the range of item capitalized smaller, the item that can be expensed right away is larger, right? So under GAAP, the item that can be deducted is much smaller than under UNICAP. Right? So UNICAP, the major role of UNICAP, the major purpose of UNICAP is to raise the amount of capitalizations of inventory costs. Right? So basically, UNICAP, the range of items that are covered under UNICAP, basically is include those items that are covered under GAAP. but UNICAP expand to include some other items that are not included in GAAP, right? So basically, the range of items that need to be capitalized under UNICAP is larger than under GAAP, right? And one thing I want to point out is that the UNICAP rule is only applied again to larger businesses, right? So for smaller businesses with less than or equal to $26 million of revenue annually, they don't need to follow this UNICAP, right? They can just use the GAAP to account for their inventories, right? But for larger companies, they have to use UNICAP, right? And then one thing I want to point out is that for the cost of selling, advertising, and research, this cost don't need to be capitalized, right? So under UNICAP, right? So let's look at this example. Maybe it's going to be clearer a little bit for you guys, you know. And this example I took straight away from the homework, so I hope this is going to help you with your homework, right? Okay, sorry. Alright, so let's look at this. So say this year Amber purchased a factory to process and package landscape mulch. Approximately 20% of management time, space, and expenses are spent on this manufacturing process. Right. At the end of the year, Amber accountant indicate that the business has processed 10 million bags, but only 1 million bags remain in the ending inventory. Right. So basically, the company has sold 9 million bags, right? And whatever ending inventory is only around like 10% of the total amount of production during the year, right? So the question asks, what is Amber tax basis in her ending inventory? If the direct costs are allocated to inventory according to the level of ending inventory, and in contrast, the indirect costs are first allocated by time spent and then according to the level of ending inventory. Right. So, as you can see, right, some of the costs here under the financial reporting regime, we may not need to include that we may not to capitalize that. Right? For example, administrative supplies or depreciation of office, you know, property tax on office. Usually under the financial reporting regime, we may not need to take into account those kind of items, right? But for under UNICAP, right, under the tax purpose regime, we may also have to include those items into the cost of inventory, right? And then we cannot expense the item right away. We have to wait till we make the sale, right? We make the sale of the inventory to be able to deduct that, right? So that's, again, I just wanted to show you, to illustrate the purpose of the UNICAP and the difference between a financial reporting accounting and a tax accounting, right? All right, so let's get back to our problems here, right? So, right, so the important point here is here, right? It's like approximately 20% of the management time, space, and expenses are spent on the manufacturing process, right? And usually, like I said, usually these items, right, these costs, usually under the financial reporting regime, usually they're expensed, right? But under UNICAP, they are taken into consideration. They are capitalized into inventory, right? So, and it's a direct costs are allocated to inventory according to the level of ending inventory, and indirect costs are first allocated by time spent, then according to the level of ending inventory. So let's see, let's try to solve this together. So I prepare a table here so that we can solve this faster. Right, so here pretty much like other list of items that I mentioned in the problems, right? So let's say first the direct cost should be allocated to inventory according to the level of ending inventory, right? So first of all, mulch and packaging. This should be direct cost, right? So, and then we use the level ending inventory to allocate that, right? And then because the question is asking what is the taxpayer, what is the business owner tax basis in the ending inventory, so that's why we try to calculate the tax basis for her ending inventory here, right? And that's why we use that's why they want us to use the ending inventory to account for the tax basis, right? So, and for the direct cost, right? So mulch and packaging, right? So we use the ending inventory level, which is 1/10, so 10%, right? Times $5,000. So we have $5,000 times $500. All right. Right. So that's the first thing. So that's the first item. We have mulch and packaging, and then the tax inventory just times 10%, right? Because it's a direct cost. Just apply the ending inventory level, right? And then for indirect costs, so now we have administrative supplies. So this is the indirect cost, right? So for indirect costs, the problem it asks us to use the indirect costs to use the time spent and the level of any inventory to account for it, right? So how do we do it? Wow, so you may not find this in the book, but the way we do it is to use 250 times first, right? Time spent on the production process rate, which is 20%. So we take the time spent by 2, right? And then we apply the level in any inventory, which is 0.1, 10%, right? So 10.1. That's give it 5. Right. So that's the way it is. That's how you do it, right? And that's the administrative supplies is indirect cost, right? Right. So salaries, $12,000, and salary for factory laborers, right, who directly make the products, right? So we're going to use the 0.10, the 10%, right? So which is $1,200. Right? Sales and advertising, well, because for sales and advertising we don't include that in the tax we don't capitalize that, right? So we don't have to include that, so we put 0 here. Salary for administration staff, right? Again, this is an indirect cost, so we take 5,200 times 0.2 and times 0.1, so 104. Right. For property taxes for the factory, well, this is the kind of like the direct cost, right? Because the factory is the one where we produce the stock, right? So again, for direct cost, we're going to use the 10%, which is going to give us for $60. Property taxes for the office, so the office is going to be the indirect cost, right? So we use the time span and the inventory level to calculate that. So again, we have 2,700 times 0.2 times 0.1, 54. And depreciation, again, for factory, it should be a direct cost, right? So we take $8,000 times 10%, which gives us $800. And then for the offices, now it's become an indirect cost, right? So we take 1,500 times 0.2 and then times 0.1. Right, so that gives us 30. Right. So this is how you solve this kind of problems, So in the book, they don't really focus on how to solve this kind of problems, But in the homework, you may find a question like this. So I just want you to show you how to solve this kind of problems, But since the book doesn't really discuss deeply about this kind of problem, so don't worry. In the test, I won't ask you something like this, maybe just something conceptual about UniCap, So I just want to let you know that. But here for this problem, I just want to show you, in case on the homework you see something like this. This is how you solve it. All right. So let's get back to our lectures. So next, let's talk about inventory flow assumption. So, well, we probably by now will be very familiar with this kind of assumption, right? So we know first in, first out, last in, last out, right? FIFO, LIFO, right? And then there's specific identifications. Right? So for for book purpose or for financial reporting purpose, right? We know that businesses can choose one of the three methods to do, right? So relatively is a similar thing to when it comes to tax purpose, right? So in tax purpose, the business owners can also choose one of the three methods to apply to calculate their inventory flow, right? Of course, for large production businesses, business with a lot of inventories, of course, it's better to apply FIFO or LIFO, because it's allow firms to keep track of the inventory without have to go and count and individual item inventories, But for businesses that have lower volume of inventory, then they should use specific identification method, right? And I don't think I need to tell you what is the difference between LIFO, FIFO, and specific identification, right? So again, so if you guys remember the benefit of FIFO and LIFO, right? So when the price of when the cost of the inventory, right? When the cost of the inventory is increasing or inflating, right? So FIFO is going to give us the highest income, right? And LIFO is going to give us the lowest income, right? So for tax purposes, probably business owners who want to pay lower tax, probably they're going to go with LIFO, right? Because LIFO gives the lowest taxable income, and in turn it's going to provide the lowest tax liabilities, right? So, however, in order to select LIFO as the method to account for the inventory flow, taxpayers or business owners have to follow some guidelines, and the guideline here is that the limitation here is that if they want to use LIFO for the tax purpose, they also have to use LIFO for the financial reporting purpose. So they cannot use FIFO as in their book, in their financial reporting for their financial reporting purpose, and then use LIFO for tax purposes, right? So that inconsistent is not acceptable. It's not allowable, right? On the other hand, if the business owner decide to use LIFO for the book purpose, right, for the financial reporting purpose, then they are free to choose whether or not they want to use FIFO or LIFO for the tax purpose, right? But if the business owners decided to choose FIFO for their business for their financial reporting purpose, then the only method that is allowed for them for the tax purpose is FIFO, right? So that's just something as I want to point out, right? So again, in other words, for tax purposes, LIFO is probably the best purpose, the best method to use, which gonna generate the lowest level of taxable income, and in turn generate the lowest level of tax liabilities, right? But taxpayers can only use LIFO if they also use LIFO for their financial reporting purpose, right? In their book, right? So I just wanted to point that out, right? So, all right. So that was it about inventory. So now let's talk about when can businesses recognize their expenses, right? So remember, we talk about the O event test for recognizing income, right? So for recognizing expenses, we also have an O event test, right? And basically, it's kind of similar, right? So basically, the taxpayers can claim a tax deduction, or can claim an expense as a deduction if the expenses meet the following, right? If the O events have occurred to establish the liability to pay, or the amount is determinable with reasonable accuracy, right? So, in contrast with the O event test for recognizing income, right? The O event test for recognizing expenses, we kind of try to postpone, try to defer the recognition of expenses, right? So we know the O event test for recognizing income kind of try to the purpose of that test is to accelerate the recognition of income, right? So the O event test for recognizing expenses work the opposite. It's trying to postpone the recognition of expenses, right? So you can see that's why usually under the financial reporting regime, expenses is recognized when it incur, right? But for the tax purposes, it has to either have occurred, right, to establish a liability to pay, or had to have a reasonable amount to operate for accuracy, right? And then under the financial reporting regime, prepaid expense can already be used as a expand account. Basically, you can start to expand already, right? But for tax purpose, prepaid expense cannot be deducted, right? So there's a limitation in terms of that's why I say this test is the purpose is to postpone the recognition of expenses, right? Because Congress, they don't want to they want to generate the highest level of tax, right? So they try to postpone the recognition of deductions here, right? So and then beside the O event test, to be able to claim the deductions, there's another set of tests that taxpayers, that the expense has to meet, and that test is called economic performance, right? So the expense must occur if it satisfies the O event test, and then at the same time it has to satisfy the economic performance test as well, right? And the economic performance basically means that there's some economic substance, some economic performance that has to have already occurred to be able to expand that way. So again, as you can see, the whole requirements for deduction is very strict. It's much stricter than a requirement to recognize income, right? And again, the purpose of having such strict requirements, right, two set of tests, is to postpone the recognition of expenses, right? So again, expense have to meet both of these tests, right? So even though if expense meet the first test, right, but it doesn't meet the second test, then the taxpayer cannot claim that expense as a deduction, right? And the second test is kind of consistent with this here, right? with the forbid on the restriction on deducting prepaid expenses, right? So let's look at economic performance tests, right? So basically the economic performance test, it requires that the expense only happens when there's some economic exchanges between the two parties. Right? So let's look at the first case here. So under the economic performance test, require the expense can be recognized if the taxpayers, in the case the taxpayer using properties and goods, meaning they are renting properties, taxpayer renting some properties or purchasing some goods or some services, right? So the transaction only occurs when the services or the goods are provided, or the taxpayer already used the properties that they rent, right? So expenses are only recognized when such economic performance are exchanged, right? Such economic performance occurs, right? So in other words, prepaid expense is not acceptable to be recognized, right? There has to be some transaction, some economic transaction, some economic performance occurred, right, in order for the expense to be recognized, right? And then there's an exception here, right? So for economic performance that is expected to be happening in 3.5 months, taxpayer can also recognize the expense, right? So for example, I think an example probably a better way to explain this kind of situation, you know. So let's say the taxpayers sign a contract with another company to provide them cleaning service, you know, office cleaning service, right? So the taxpayers pay for the services upfront, right? And the service, the contract say, well, the other company going to provide a cleaning service for this firm for the next 3 months, let's say, right? So even though the performance is not yet happened on the date of the payment, or on the date of the contract signing, right? But because the economic performance, meaning the service that the other company is going to provide to the taxpayers, is going to happen within the 3.5 months windows. So because of that, the taxpayer can still recognize the expenses, right? Meaning the expense still pass the economic performance test, right? All right. So that's the case where the taxpayer using properties or purchasing goods or services from another person, right? What about the cases where the taxpayers are liable to perform some services or some goods, you know? Maybe they're responsible to perform some services, you know, and then they have to incur some expenses to fulfill those services, right? So in that case, the economic performance test, the economic performance only occurs when the taxpayers actually fulfill that liabilities, right? Fulfill that liable services that they are due to do, right? So again, there still has to be some actual performance, actual economic substance that has happened to be able for the so what we just talked about, like those scenario that we just talked about, regarding to kind of related to like prepaid kind of expenses, right? Prepaid expenses. So what about the other opposite way, right? So what about the cases where the expense are already formed, you know, the taxpayers identify the reasonable amount that they are liable to pay, but they haven't fulfilled the payment yet, meaning they haven't paid yet. So what about those cases, right? So there are some certain liabilities that deemed to only perform when the taxpayers pay such liabilities, right? So for example, worker compensation, refunds to clients, or some awards, some prizes that the taxpayers are due to pay to someone, or even taxes, right? So tax only happens when the tax is already paid, right? So for those cases like that, performance only occurs when they are paid, right? So again, these are just a few scenarios that are included in the economic performance test. So depending on the types of the expenditures, we can apply to each scenario and then try to find out whether or not the taxpayers pass the expense of the taxpayers pass the economic performance test, right? And again, I just want you guys to remember that for the expense to be qualified as a deduction, there are two tests that the expense had to meet, right? The O event test and the economic performance test, right? So again, it's much harder to recognize the deduction than to recognize the income for tax purposes. Right? All right. So let's look at this example, right? So this is an example of economic performance, right? So let's see. So it's a BAN has signed a binding contract for Peters to provide BAN with a repair service. Right? So BAN is trying to ask Peters to provide him some service, and then they sign a contract, right? So BAN paid $1,500 to Peter and owns an additional of $6,000 on the contract. And the repairs will commence late next year. So the question asks, when can BAN claim the deduction if he uses the accrue method? What do you guys think? Well, so we know that the value of this contract is $7,500, right? So for the first test, for the O event test, this expense should pass, right? Once we know the amount that the accurate amount that the accurate amount of the expense, right? However, for the economic performance test for the current year, the expense doesn't pass, right? Because nothing happened, no performance has happened in the current year, and then the service is promised to be happen next year, right? So that means in the current year, BAN cannot expand anything, right? It's way past the 3.5 month window, right? So what service is due to happen next year, right? So this current year, BAN cannot expand, BAN cannot claim the deductions of the $7,500, right? But next year, when the performance actually happens, when Peter, right, the provider of the service, actually provide the service to BAN, then BAN can claim the BAN can recognize that expense, right, and then can claim that as a deduction. Right? All right, so so BAN can only claim the $7,500 deduction next year. Right. All right, so let's talk about bad debt expense. So how do we take care of bad debt expense? How do we account for bad debt expense for businesses for tax purpose? Right. So as you know, as you guys remember, right? So for financial reporting purpose, bad debt expense are usually usually estimated, right? So we estimated the uncollectible account, and then we recognize that as a bad debt expense, right? But for tax purposes, estimates are not good enough, right? We cannot just use estimate to to recognize expense, right? For under the tax purpose, under the tax for the tax purpose, the bad debt expense is only deductible when the debt actually become worthless, meaning the taxpayers or the business owners know for sure that the bad debt, like this bad debt, really bad debt, like there's no chance that the bad debt's going to turn into a collectible amount, So only then that the business owners can deduct the bad debt expense. Right? So remember that, right? So remember, for financial reporting purpose, bad debt expense can be estimated, but for tax reporting purpose, bad debt expense has to be really bad, right? It has to be worthless. It has to be uncollectible to be able to for the tax owner for the business owner to deduct, right? All right, and this is going to be the last item, the last topic that we're going to talk about in these chapters, right? So, choosing and changing an accounting method. So, as we have talked, right? So there are some methods that are depending on the type of the businesses and the characteristic of the businesses that taxpayers can choose from different methods, right? So for some taxpayers, for example, for corporate, for large corporation, right, they can only use accrue method, right? But for smaller taxpayers, for taxpayers with revenue of equal or less than $26 million, they can choose between cash or accrue method, right? So that's just an example, right? Or right. So that's why there are some what we call permissible method and what we call impermissible method. So permissible method, meaning that allowable method, right? Meaning it is legal for the business to pick such method to apply to their business, right? And then impermissible method just means that it is not allowed, right? But somehow the business just still either they make a mistake or they intentionally apply the wrong method to recognize their tax, right? So usually, as we have mentioned earlier in these lectures, right, permissible method, right, or allowable or really legal method usually are applied and adopted by from the first year of the tax return, right, from the very beginning, right, and they are deemed to be adopted by simply the selection of the method of the first year, right? So let's say if your company chose to use a cash method instead of accrue method in the first year, so they are deemed to be, and they're allowed to use it, if they are allowed to use that, so they are deemed to be select that method for the following method unless they make some adjustment, right? For impermissible method, they are deemed to be adopted, meaning the IRS can assume that the company chose to follow such method if the method is applied for the applied in the business for more than 2 years, or 2 years or more, right? If the impermissible method is applied for only 1 year, then maybe the IRS gonna treat that as a simple mistake, But if it's applied to the business, if the business owner choose the wrong method, choose the impermissible method, and have used that for more than 2 years, then the IRS may or may not, assume that this is the intentional mistake. And again, it's depending on the argument of both sides, And but still, for these cases, the consequences may not be that good, right? The taxpayers, if they are deemed to choose to use the impermissible method, they may subject to some sort of fine or penalty from the IRS, right? All right. And then we mentioned about method changing, right? So usually method are adopted from the first year, right? But if firm decide to choose their methods, they have to apply for it, right? They have to notify the IRS, and they have to ask for the IRS permission to change, right? So majority of the method change and majority of the significant method change are only permitted if the IRS give the business owners the green light, right? However, there's still some small changes that are automatically applicable, you know. So yeah, but in general, the business owners should or need to ask for the permission from the IRS to be able to make the change, right? So alright, so this discussion is the end of our chapter 9. I know the later end of this chapter is a little bit conceptual, you know, and it's maybe you guys may find it hard to wrap your head around, but still, right, the major thing that I want to focus on this half of the chapters is that you guys know the difference between the major difference between financial reporting purpose and tax reporting purpose, right? So that the objective of those two regimes are different, and that's why there's the difference in terms of the rules that are applicable for each purpose, right? So all right, so if you have any questions, just let me know, and I'll see you in the next video. Take care.